Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, it's great to be here on Financial Strategies with you again today. And, I was thinking about this, one of my, if I had a friend, I know that you've got experience. You were a mechanic before getting into this business, and you got a mechanical background and everything like that. And if I had a friend that came to you, or you had a friend came to you that said, "Hey, Daniel, I want to pay you to find me somebody to fix my car." I mean, what would you say to that person?
I'd say look at Google reviews. That's a little crazy. Go check out on the internet. You can do that yourself. It's ridiculous to pay somebody to
Exactly.
find you, pay a mechanic to find a mechanic. What are you talking about, man?
Exactly, right? So that's
That
exactly what
sounds like something our government would do.
Yeah. But that's exactly what some people are doing with their finances, with their retirement programs, and everything like that. Unfortunately, I've seen it way too often where, right here on our road here in Guilford, there's this company that their clients are paying anywhere between 1.5 to 2% all in on what they're managing. And the bulk of that is going to the people who are just finding the mutual funds that they're investing in. So, it's not the bulk of it is not even going to the people actually, managing the money, or fixing the car, so to speak. Most of it is going to the person just finding a person to fix the car. And if fees, I'm not against fees, but egregious fees for, and what you're getting for those fees are what I'm unhappy about. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about 6 keys to retiring in a recession. And AAA, I guess before we start, people need to ask, what is the purpose for their money? What's the purpose? Like, why do you have these retirement accounts? What's the idea? Is it to retire? Is it to barely make it by? Is it to leave an inheritance? Is it to go? I was talking to somebody the other day. They were talking about the traveling they want to do. They're retired now, like the traveling they want to do. Is it to be able to do that in a recession or not recession? Is it to pay fees? Like, do you have this retirement portfolio so you can pay fees? You can pay someone to hire you a mechanic, right? I think I think investors need to think about, what is the purpose for that retirement money that they've signed up or
Yeah,
saved up.
exactly. Because you know what the purpose of the money is the key. Because if you know what the purpose is, then you can set up a strategy that works for the money. It's no different than what we do in our life. The more purposeful we are in our lives, the more we understand God's purpose for putting us on this earth, the better off, the more fulfilled we're going to be. And the same thing, it's just the same thing. The purpose of a portfolio, if you understand what that is, the more fulfilling that portfolio will be, the better steward you will be of that portfolio, and the farther and the longer it will go. But just as so many times in life, people are purposeless, so many times with people's financial portfolios, they are purposeless.
Mm.
And or they just think in the broad terms, oh, that's for my retirement. Well, what does that mean for your retirement? Like you say, do you want to do traveling, or do you want to do things in a recession, not in a recession? When do you want to do these things? You just want to do things whenever you can do them, or do you only want to do things when things are good? And
Yeah,
um,
yeah,
and when it comes to that, fees are a big thing, because fees, again,
huge.
we see fees across the board, right? Banks, everybody's, it's all about fees today. You know, um, as you know, Daniel, I got a new car yesterday, and when you were with me when I was doing that, and they're trying to add on all these fees to it. Of course, they were voluntary fees, but they're making you think you're getting something for it. But in the end, you're just giving them money. It's just excess money. I mean, it might be worth something, but the chances are, I would rather invest my money, put my money in Bitcoin, and probably end up with more than what I'd get from those extra fees, right? And banks are doing this all the time. They're charging, raising their fees for bounce checks or various things, and they used to give you some of those fees back out of courtesy. Now they're not giving any of those fees back, right? They're holding your money for sometimes a week or two before they clear a check. Why? Because they're earning money off of that money. It's all about fees, is how these companies make money. But what the buyer has to be aware of is, what fees are you paying? And that's what, the first key to retiring in a session is: be aware of the fees you are paying. So many people I talk to have no clue what their fees are. They don't know the percentages they're paying. They don't know what the dollar amounts they're paying. I ask them, when we do a retirement risk report for people, that helps people to be able to analyze how set they are, if they can retire, when they can retire, how well they'll be for retirement. One of the questions that we ask in prepping to do that is, what are the fees that you're paying? And over and over and over again, people say, I don't know. Along with that, I say, well, do you have a fiduciary contract with the people that you're working with? And again, they say, oh, probably. But I said, well, where's the document? And they, oh, I don't know. And so if you don't have a document, you don't have a fiduciary agreement. And it's just amazing how people are just hoping they're going to be able to retire, but have no clue, right? And one of the big things is fees, because fees dig in. In that illustration I gave at the start of the show, if you're paying 2% all in, you have $1,000,000, right? That's $20,000 a year that you're paying to have somebody manage your money. And if the $1,000,000 goes down to 900,000, you're still paying $18,000 a year, and you're not making anything. It reminds me of our newest clients that say, we've been with so-and-so big name company for 3 years, and they've made more money than we have over the past 3 years, right? How many times do we have clients come in and say, I don't mind paying you fees. I just want to make more than what you're making. And that's the key. The client needs to make more than what the financial advisor is making. And that is a big thing. If you're not doing that in a recession, that's going to dig into your assets, and it's going to lessen your retirement. So I need to remind you, I'm going off. I'm like, very passionate about this and not realizing what the time here. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 6 keys of retiring in a recession. And we're talking about these. The first key is understanding the fees that you're paying. We have a paper that we'd love to give you to be able to go along with this. We're not going to hit upon the Secure Act 2.0 in today's show, because that's another key to this, but we want to give you a paper where you can read about it yourself. Secure Act 2.0. You can have that paper for free by calling us at 800-725-7616 to get your free copy. Call now, 800-725-7616. Daniel, fees are a huge thing.
Yeah. There's another
of
fee that you didn't mention, and this is one that drives me crazy, okay? What you're talking about is very, very important. Fees in a recession are tragic. If markets are going up 40% a year and you're paying 2% out, whatever, right? The problem is people, they sign up, they don't realize what they're paying, they don't realize. When you're talking about the mechanic, you're talking about what ends up happening is an advisor will charge a fee, maybe 1%, maybe 1.25, maybe 1.5. And
right.
then inside the funds they buy, there's a fee between 0.5% probably and 2%. Variable annuities are the worst. We've seen 3-4% internal fees, and people have these things for 10 years and they've made no money. And you say, well, look at what markets are done. How have they made no money? Well, because markets, people say average 7-8%, but there's no years that they've done 7-8%. Practically no year that they've done 7 or 8%.
Right.
And so averages fool us. So when you have a down year, like right now, a lot of people are down from the high.
Yeah.
And you have 18,000, your scenario came out, It's
Yep.
very hard to recoup that because when markets go back to even, you don't. So even if
Exactly.
you didn't take any money out, now if you took money out because you need to live life
Yeah. That's
and the
another thing.
18 came out, you're in big trouble. So fees are tragic when you are not saving. Okay. If you're saving, maybe it's not as bad. But when you're getting close to retirement, these things really add up. If you're 30 years old, you're maxing out 401k, you're maxing out your savings, you're doing these things, and you want to pay somebody 2%, well, it's your money. But when you're in retirement, if you want it to last, you got to watch these things because when you're not saving, it cannibalizes your money without you taking anything out.
Right.
The
Right.
other fee that people don't realize, and what really gets me upset, is they have their money in the bank. They have a lot of money in the bank, much more than they need.
The hidden
100,
fee.
200, 400, $1 million in the bank, and they're not earning anything. So if they have $500,000 in the bank, that is costing them $25,000 a year,
The hidden fee.
a hidden fee. Do you know why I say that? Because you're earning nothing, and you could take that money, you put it in a treasury note, a short-term treasury note, and get 5%
Guaranteed.
right now.
Yeah.
And that's safer than the bank because your bank limit is only $250,000. Banks are going bad left and right, and you're over the limit. So it's not safe and it's costing you what I mean, you want to buy a new snowmobile, you want to buy a boat, you want to buy your kid a car, you want to send somebody to college. I mean, that's $25,000. You
You
want
want
to
to
you want to
eat?
help missions, you want to give it to the church. If you don't want the money, there's plenty of other people you could help with that
That's right.
$25,000.
That's right. Instead of the bank. I mean, somebody's making money on that money. So it's the hidden fee.
Mm-hmm.
There's the fees that are pronounced, and then there's a hidden fee. Like I said to you earlier, on those documents I signed yesterday for that car, there was that hidden fee. It was on the document, but nobody said anything about that
Mm-hmm.
fee, right, Daniel?
Yep.
And I saw it there, and I
You
said,
pulled
"What's
it
that
up.
for?"
You
And I said,
waited
"I
to
don't want
see
to
if
pay
he
that
was going to
fee."
say anything, and he never did.
That's right. And so you got to be aware. You got and I'm not again, I'm not against fees. Our clients pay fees, but our fees are half or 25% or quarter of what I what they're typically paying at other places. And what they get, what do you get for that fee? Is it a customized approach? Is it a customized portfolio? Or is it just cookie cutter? Well, what we're giving our clients is customized portfolios. And who wouldn't want a customized suit, a customized car, right? I mean, I love that, right? I finally got my Bronco that I ordered a year and a half ago, and it's custom to me. I love
Yeah.
customized stuff, right? And I actually got it at a discount. Thank you, Drew. And and so that's a great thing. So that's what we're offering to people: customized stuff at a discount. And but people don't even know what they're paying, so they're not getting a discount. It's easy, so they're probably paying more. So anyway, I'm not against fees. The question is, what do you get? How much are you paying, and what are you getting for that? And too many times, people are paying a ton and not getting anything for it. And
And
that's
are you making more than your fees in a recession? That's huge, right?
right,
Are you earning more
right,
than the fees when markets are good, bad, or ugly?
right. Our clients are earning multiples of what they're paying us right now in a recession. This beautiful thing. Listen, if you just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is six topics and six things you need to know regarding retiring in a recession. And today we are giving away, instead of the usual book we give away, we're giving away a $2,000 report. This report is called Retirement Risk Report, RRR. What this report does is tell you how your portfolio is set up for you to retire. Now, I may be years away from retirement. That's fine. It tells you what you're on track for. It looks at your fees. It stress tests your portfolio. If we have another 2008 or another 2002, what your portfolio would do. And if you're in retirement, that's a key thing to know. So it allows you to go in retirement. This is a proprietary report. You're not going to be able to get this anywhere else. It looks at your taxation. It looks at your fees. It looks at your diversification. It looks at what's guaranteed and what's not guaranteed. It is very comprehensive in a very short report that's easy to read, very user friendly. We have this for free. When we charge for these things, we charge over $2,000 to be able to do these things for people. Because you're listening to the show or podcast, we're going to offer it to you for free. If you would like that, call 800-725-7616. Ask for the RRR, Retirement Risk Report. RRR, 800-725-7616. Call now.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Dad, why are we doing this show? Why are we doing this show? Why are we doing 6 keys to retiring in a recession? Because too many times recently, I've had people come in and say, right, prospects come in and say, I said to my advisor, I want to be moderate to low risk. And now I'm looking at the portfolio and it's down $60,000. It's down $150,000. And I said, what's going on? What's going on? That's not what I asked for. I'm Daniel Agemy.
And I'm Andrew Agemy. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic, 6 keys to retiring in a recession. And we're talking about this. The first one we talked about was fees, egregious and too much fees, not knowing your fees. People need to understand what the fees are and what you're getting for the fees, the hidden fees within your portfolio, the hidden fees in the bank that you're not earning money because they're making the money on top of it. So now, Daniel, risk, right? Risk is a huge thing.
It's enormous, and people don't understand it. People in general have a really difficult time understanding risk because we're emotional beings. Mm-hmm. And what ends up happening a lot of times is advisors use different words, different definitions than what the investors use. Another thing that happens is people are looking for momentum. So when things are really bad, they think things are really risky. And when things are really good, they think there's no risk, right? And one of those things I like to say is like risk becomes your friend, right? When we go into a long drawn out economic boom, risk becomes people's friends. Risk is my friend. I will take on as much risk as possible, right? We can see these on things like the tulip bubble, or we can see things like this, even like when Bitcoin a few years ago ran all the way up to $70,000 a coin. People wanted to buy it at 70,000. They weren't interested in buying it at 1,000 or 2,000 or 5,000 or 12,000, but they wanted to buy it at 70,000, right? It seemed less
Hindsight
risky.
is 2020, Daniel.
Yeah. Or the NASDAQ, when it's trading at a 40 PE, it seems not risky because it's only going up. So risk can trick us. And then when the advisor is using different words,
different
like
meanings,
different meanings, same words, different meanings. And you've seen this so many times.
Yeah, definitely. I mean, the key thing that I always like to say is when, kids are growing up, they're 15, 16 years old, and their definition of done compared to their parents' definition of done, they're using the same word, but they're 2 totally different definitions, right? And we can see that in a lot of different things, but especially in the financial world. So many times I will ask somebody in and close to retirement, are you a conservative investor or aggressive investor? They'll say, well, I'm conservative or I'm moderate. And typically what I found is that their definition of conservative is not losing principal. Everybody wants to make as much money as they can, but not losing principal. Well, then I look at I say, well, how much do you think you should have at risk? And they'll say 10%. And then I look at their portfolio and they have 90% at risk. And I tell them that. And they say, well, how could that be? My advisor knows I want to be conservative. He said I'm conservative. I said, well, his definition is the conservative end of aggressive, not at where you can lose principal, not the conservative end of conservative. If we divide all investments down to conservative, moderate, and aggressive, and then subdivide them. So different definitions, which is key, and it will throw people off. And you don't understand it. It's kind of like insurance. You don't know how good it is until it's time to use it. And then it's too late to change it. Well, people think, oh, I'm believing this guy, I'm conservative. And then the market drops and you lose money. And now, all of a sudden your definition is not the same. And you lost money. And I took so many times, right, Daniel, we hear, oh, like I lost money like everybody else. No, not like everybody else. We know a lot of people that are not losing money. We know a lot of people that are making money right now. How much money are you making?
Yeah, people's capital is so valuable. And two things. One is when people don't understand the value of their capital, especially right now.
Right.
And two, when the advisors don't respect your capital, they don't
Right.
respect your retirement savings. Um, they are listening to someone who sends them a report that says you need to buy these funds. And that's, again, going back to the fees where it's just you're paying someone to find you a mechanic to work on your car. You're paying someone to just put a bunch of funds in a portfolio and call it whatever you want it. I want conservative, I want moderate, I want aggressive. It's the same thing for all, right?
Right.
Now, maybe we're being a little bit harsh, but the problem is we see these people come in all the time that thought they were getting one thing and they got something else and they're mad, but there's not a lot that they can do about it except change now. And
Right.
and um, we want people, the reason we're doing the show is we want people to make that decision on purpose instead of by mistake, or on purpose ahead of time instead of by necessity because you waited and now you have a problem. Now you have a problem because your assets are dwindling and you're saying, wait a second, I still want to retire. I'm in retirement. I need this to last another 20 years. Right. And that's why we believe second opinions chambers to save lives, for example, right?
Right.
Um, but that's what we're talking about. That the risk is a big thing, and we believe you should always be getting paid. When you're in
Right.
retirement, you need to be getting paid when markets are going up, down, or sideways. If it's not happening that way, what are you doing? Are you speculating or are you investing?
Right.
Right? Do you
Right.
want to speculate with your retirement savings or do you want to invest your retirement savings?
Hope is not a retirement plan, Daniel. If so, how many times people say, "Well, I hope I'm going to be able to retire." That's not a retirement plan, and you don't have to live that way. So that's the exact same point. Another way, Daniel. Well, let me just give this identification. You're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is 6 keys to retiring in a recession. Things that you need to know to retire now or soon, because we're in a recession and things are difficult out there in a lot of ways, and they're going to get more difficult. And if you're getting ready to retire, you need to be prepared for that. So that's why this is. We started talking about fees and how egregious fees can dig into your portfolio. You need to be able to make money. And then we're talking about risk. And of course, risk can cannibalize your assets. We have a paper to go along with today's show. It's called Secure Act 2.0. Secure Act is another aspect and thing that you need to understand thoroughly when retiring in a recession, but we don't have time to go into it today. So we'd like to give you this paper to educate yourself on it. And you can get it by calling 800-725-7616. Ask for it by name. Secure Act paper. Okay, the Secure Act paper. 800-725-7616. Daniel, when we're talking about risk, another aspect about risk is that people need, if you're in our listening audience, please understand, if you're risking working with somebody other than a fiduciary, you're increasing your risk. Even if you're working with a fiduciary, you need to make sure that you're working with the right kind of fiduciary, a true fiduciary. Again, get back to what Daniel said, using the right definitions for the words, for the terms, and we can go through that with what a true fiduciary is versus just a fiduciary. And you're increasing your risk if you're not working with a true fiduciary. So please recognize this and make the changes accordingly, because so that you can retire and stay retired. That's what our goal is. That's why we're doing a show. We want people to retire and stay retired. We're tired of seeing people having to go back to work because they have to. We're tired of seeing people not being able to retire because they can't. We're tired of seeing people to not being able to do the things, sitting on the couch for retirement, watching TV instead of doing some travel and some of those other things that they have on their bucket list. So, let's move forward here, Daniel.
And one more risk. If
Yeah.
you, especially if you're an entity, if you are a treasurer for a church, okay, or you're a pastor of a church and you have more than $250,000 in the bank,
Yeah.
you're taking on a lot of risk that you should not be taking on. And that's another risk. Individuals too, but at least it's your money. And if you lose it, it's not a big deal,
Yeah.
right? We help some churches, we talk to churches, and you need to be stewards of that money. And so if you are part of an organization like that and you're over those limits, you either need to move it into a bunch of bank accounts or you need to get in some treasury bills where it's safe. And, if you don't want the interest it's going to earn, give it to missions, right?
Exactly.
But that's something that we've seen a lot recently. And I'm very worried for those people because if you're counting on God to make sure your bank doesn't go bad because you made foolish decisions, that's not a good move to make.
Daniel, oh man, you're pulling my heartstrings today. Oh, it's nice to see the second generation. That's exactly why we Agemy Financial Strategies exist, is because to help people. God has set me forth on a mission to help people be better stewards of the money that He has given to them. And to hear you say that, Daniel, is just like, that's what I've been, I know that you believe that and everything like that. And that's fantastic to hear you saying that, because that's what this company is all about. And let me speak, if you're a pastor out there, you're a fiduciary for that organization, for that church, to God. Not only you have God looking over your shoulder, but you have the government looking over your shoulder and the people in the congregation looking over your shoulder for how you're handling that money. And you have to handle it, you're legally obligated to handle it in a prudent fashion. And by keeping it in the bank, making no money, you're not being prudent. And let me just say that we help churches and we charge them zero, because in my mind, this is God's money. I'm not charging God because God has set me up to do what He is, what this is all about. So, pastors, if you're listening to this, you need to give us a call, because we can help you in ways that I'm sure you're not going to find anywhere else. Because I don't think there's anybody else out there that are not charging. Because so many people are have the mindset, well, I'm in business to make money, and yes, we are. But I make that with my clients, churches. I'm not going to make that off of God. God is the one. His shovel is bigger than my shovel. I'm going to give to God. Freely He's given me, freely I give back, and that's the idea there. So we have this retirement risk report that's RRR, that's available for you if you're other than churches. Churches, we're going to talk to you and we're going to be able to help you in whatever fashion, pastors and whatnot. But as far as individuals out there, this RRR, retirement risk report, is going to look at your retirement portfolio to see if you're paying egregious fees, to see if you're paying hidden fees that you don't know about. It's going to be able to look to see what your risk is. It's going to quantify your risk in a way that is according to your definitions of risk. Okay, not Wall Street's definition of risk, which is totally different than yours, I'm sure. And so this is happening. This is a $2,000 report we're giving away for listeners to Financial Strategies with Andrew Daniel Agemy. So 800-725-7616 to find out how to get your RRR and get on the calendar so that you can start with that process. Retirement risk report. Ask for it by name. Ask, I want the RRR. 800-725-7616. 800-7216. We'll be right back after this.
This is Financial Strategies with Andrew and Daniel Agemy.
Jim and Shelley came in, Daniel, to do their taxes. And this was several years ago. And I looked at them. I said, congratulations, you didn't pay any taxes this year. And they were like, hey, that's great. I said, however, on the other hand, I want you to pay taxes the next few years. And then we're going to get you to where by the time you reach RMD age, you're not going to have any more taxes. And you'll be tax-free basically for the rest of your life. They said, we love that, Andrew. Let's do that. So we went through, and we have, for the past several years, been on a trek and a trajectory of getting them to be tax-free. And guess what happened this year, Daniel? We hit that. So next year, they're going to be tax-free for the rest of their life. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about 6 keys to retiring in a recession. And AAA, these 6 keys, every decision we make has second and third ordered consequences, right? And those could be good or bad. But these 6 keys may seem simple, but the third, fourth, and fifth order consequences are very, very positive. It's crazy what they can do. The compounding, even in retirement, how fast these things can
That's
start
right.
compounding. For
That's
example,
right.
your story with the tax free, it has so many like it seems simple. Let's convert. But then there's so many other things that you can avoid, so many traps, so many pitfalls
Yep.
that you can avoid by having Roth money. And we call this secrets to converting money because there's some really secret, sneaky things people don't know about, right?
Well, I wouldn't call them sneaky, Daniel. I'd just say, under the radar, maybe that's a better word, maybe.
One is people will say stuff to me like, I can't contribute to a Roth, or they'll say, I make too much money, or I'm too old, or these kinds of things. And we say, well, you don't have to contribute.
Right.
You don't have to have earned income because we can convert. You can take money out of your 403b, out of your 401k, out of your traditional IRA, and you can convert it. Now, you need to be very careful and you need to know what you're doing when you do this, but you can get money over, especially right now while taxes are on sale.
Yeah, Daniel, it's so egregious. How many times do I just recently I saw another portfolio that came across my desk that where the people had gathered all this money that was not IRA money that they were going to pay taxes on the growth. And it's like, why didn't you do Roth IRAs way back when? And why didn't your financial guy set this up to be tax free? Because most professional financial people don't do that. And folks in the listening audience, you're not going to hear this from your CPA. You're not going to hear this from your Vanguard person. You're not going to hear this from your Fidelity person. You're not going to hear this from your Morgan Stanley person because they don't deal with this kind of thing. They're not looking to be able to set you up for tax-free nature. Why? Because they don't understand the nature of it by themselves. Accountants, I can't tell you how many times accountants, they're being counters. And they say, oh, if you're not going to make back your money by such and such. That's not the key. The key is what you're going to do over the long term. And if you live, certainly if you're, I tell you something, if you're a married couple and you're 65 years old or older, the chances of one of you reaching 90 years old plus is huge, huge. So your money needs to be able to last that long as well. And if you are paying taxes on your money, it's not going to last as long as tax-free money will. When are you paying? If you take $1,000 out, when is it not $1,000? When you have to pay tax on it, maybe it's $700. But if it's tax-free, take $1,000 out, you got $1,000. That can go a lot farther than $700. So that's huge, and be able to understand this. A key thing in recession that when you have tax-free money that's compounding for you, it's going to go a lot farther over the long run. Good.
And this works for young people and old people because both will say it doesn't work for me, right? Like a story, a young person, um, not thinking about retirement, converting her IRA to Roth, and they're like, we're paying this much taxes to convert. Well, there's a position, right? Meta that we bought when it's people pricing it to fail. This is like a year or two ago. It's up close to 200%
Wow.
in the Roth. That's tax free at earn. So when you can earn money like that, who cares what you paid in taxes because the growth is all tax free. These things happen, and
Yeah.
this is why you convert it. And then on the other side, if you're older and you're like, I'm too old to convert, well, it's still a calculation because if you got $1 million and you're collecting, I mean, you can get great income right now. You could get $65,000 a year of income off of that. Do you want to just take $65,000, put it in your pocket and get $65,000? Like that's insane. Like have the accountant that tells you that's not a good idea to do the conversion. Look at that and see you collecting that $65,000 every year for as long as you're alive, right?
Well, and that's the thing, Daniel. These people, these CPAs, and these self-service companies like Vanguard, Fidelity, and even these big companies, they don't have the software that we do that can calculate these things and show people these things in a fashion that that can work. And so it's hard for people to visualize it without and to understand some of this stuff sometimes without visualizing it. And you don't have to come to us to do it. I'm just saying there are people There you can get this stuff done by the right people. That's the key. Is having the right people helping you. Listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what they don't know. We want to educate you so that you can have and so that you can know, you can make the right decisions. Today we have a paper we'd like to give you help you understand these things. And when we're talking about 6 points about retiring in a recession and 6 keys of retiring in a recession, one of those things, another thing that for that we don't have time to go into today is coronavirus and finances and how that and this whole thing that has transpired in our world today, especially the United States. We'd love to put this paper in your hand that will help educate you on it. It's about 2 pages, 2.5 pages long. 800-725-7616. 800-725-7616 for your free copy of Coronavirus and Finances. Ask for it by name, just coronavirus. Daniel, when we're talking about these things and the tax-free, it's so important for people to have the right person helping them. How many, you know, how many financial advisors does it take to ruin somebody's retirement? One. So you got to make sure you get the right one. I've got some issues, some things going on here with my property here in Guilford, where I'm being infringed upon by somebody, my property line and such. And I talked with my real estate attorney, spent thousands of dollars with them to find out that he was the wrong kind of attorney. And I had to find a different kind of attorney, the right person to help me. And this person is helping us to move forward. And I feel like I wasted my money on that other side because it was the wrong one.
And
And you need to make sure that you've got the right person, the right people helping you to go in the right direction.
yeah, and I think that's perfect because that brings us right on to our next point, which is not people not moving their 401ks, their 403bs, the 457s,
Right.
right? The retirement plans at work. And the IRS, the government realizes that at around 60 years old, people
Yep.
need to really be focused up on retirement,
Right.
and they allow people to roll those over where you can get someone that understands retirement, not how a 401k works, not 401k brain, not dollar cost averaging, not saving money. Like we're not talking about that new 2.0 Secure Act 2.0, but one of the silly things in there, right, is that
Yep.
they allow you now after 70 to contribute to an IRA. And it's like,
Crazy.
so in your retirement, you want to keep contributing. That's like the backwards thinking that's going on. Like if you start, if you get ready, you roll this over and you get someone who knows about retirement in your 60s, beginning like when you're allowed to roll that thing over,
Right. Without
you don't
penalty.
have to worry about contributing in your 70s, right?
Right. If you handle it right, you don't have to worry about those things that the government is trying to help you with. But it's amazing, right? Even the government understands the nature that we're on 60. You need to be able to do that, and you can do this tax free and penalty free. And you can put it, you can rearrange it instead of all the different options that your employer gives you. You can have a zillion more, but things that can actually fit a 60-year-old or 65-year-old or whatever the case may be. And sometimes people actually retire and they still have things at their employer, which is crazy too, because that just negatively affects your RMD, just a lot of ramifications that you need to be able to understand to get the most bang for your buck. That compounding, like you talked about earlier, Daniel, right, can you do a little bit of compounding here, a little bit of compounding with the tax-free nature, a little bit compounding because you're not paying fees, all these things. It can add up to huge compounding in a few years,
Yeah.
and the people don't
And
get it.
here's an example of why um, savvy retirees are rolling these things over. Okay, I was talking to a client, and she has one, and she wanted to roll it over. She has money about 250,000 already in an IRA that she's already rolled over, right?
Right, right,
And markets the last couple of years have not done much, right? They're just
right,
kind of
right.
Well, she's earned $15,000 on the 250 portfolio and then like
Woo!
$17,000 in dividends and interest. And I said to her, look at what's happening. When markets aren't doing anything, This is like you contributing, right? How much do people contribute to their 401ks? 15,000, 10,000, 5,000. She contributed essentially 15,000 and then 17,000 2 years, not because she took any money out of her pocket, but because her assets paid her, right? And
Yeah.
so what ends up happening is if it's flat or down, if markets are flat or down, it benefits you more than if they go up. Now you still your account will go up faster if it goes up, but you get better yields, which makes it compound faster. So it's a win-win scenario. If they go down, you win. If they go up, you win.
Yeah, people don't get the idea. They think by putting in the market that their money's going to compound. Unless you have a significant dividend, your money's not compounding; it's just growing. And compounding happens when there's multiplication, and that's what Daniel's talking about here. And it's really a great thing. Compounding is, like they say, the eighth wonder of the world, right? And that's what we're talking about here. And most professional financial people don't do compounding; they do growth. Um,
And
so,
in the 403b, in the 401k, there's
oh yeah,
restrictions. There's restrictions. So that scenario where she earned 15 and then like 17 in dividends and interest. This is money that companies paid her. It wasn't growth. We're not talking about anything like that. This is money that poured into her account.
almost.
You can't do that. You can't do that in most 401ks,
No,
403bs because
no,
they have restrictions and you
yeah,
can't buy income producing things. It's
right.
like a fund that says dividends on it that pays maybe 3% or something like that.
Well, if that,
If that, yeah.
and then the fees that come into play, you don't end up with that. So, that's great, Daniel. That's a great situation here. So, being able to understand these things can help you to be able to compound that. Well, I see that it's time for us to take a break. We're giving away today a $2,000 report for those people that want to know what they don't know. It's called the Retirement Risk Report, the RRR. This retirement risk report is a second opinion where it's going to give you an idea of how your money will react if we have another 2002, 2008. The market goes down further. It tells you what kind of condition you'll be in for retirement. It looks at what you need for retirement, what you want for retirement. It looks at your risk. It looks at the taxation, and it's in a simple report that's easy to read, very user friendly. We're giving this away for free for those that want it. Call 800-725-7616. If you're listening to this podcast, you're listening to this radio show, we're offering this to you for free. 800-725-7616 to call to set up your consultation to get going on getting this taken care of for free, no obligation. 800-725-7616. Ask for it by name, Retirement Risk Report, or simply RRR. We'll be right back after this.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
1998, my wife gave birth to our seventh child, Matthew. Great kid. Our lives have never been the same after his coming into this world. Just like the rest of our seven more children, 8 children total. But anyway, the difference with this kid was my wife had a kidney stone that caused her great pain when he was born. And after he was born, we had that kidney stone. We had it blasted 3 separate times. We had to wait a month in between each one, 3 separate times. Didn't break. I get a call one night from the doctor. Hey, we need to cut this thing out of here. It's going to cause her problems, and we got to cut this out. And I'm thinking, he's talking about cutting up my life mate. I have 7 children, 14 and under at this point. I have my own business to where that's going to jump into, my time and everything associated with that and mess up my likelihood. I think I need a second opinion. How many doctors does it take to mess you up? One bad doctor, right? So we go. I'm gonna do the short story here. We went around to some different. There's a longer story, obviously. There's always a longer story with me. Anyway, we ended up with a doctor at Yale. The doctor said, "Hey, let me look at that. Let me look at that X-ray." And we showed him the X-ray. He said, "You know what? Where that kidney stone is, it's not going to give her any problems. Don't worry about it." The kid is 24 years old today. and she's not had an issue there. Am I grateful for second opinions? You bet I am. And I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Hey, today we're talking about the 6 keys you should know about retiring or being retired in a recession. And things work a lot differently, right? When you're in a recession, when you're around a recession, um, than when everything's booming, booming, booming like it has for the last 13 years or so.
And things that work a lot differently when you retire. It's a whole different deal. Everything's changing. Your paycheck changes, your schedule changes, your friends change. Everything changes, and so you need to change with it. Right? Three things in life are certain: death, taxes, and change. And things change when you retire. People don't often think about all the ramifications that, like you said earlier, Daniel, the third and fourth consequences. The third and fourth consequences of retirement, people don't get. And so sometimes they're not prepared for that, or they run out of money, or they have to go back to work because they didn't take into consideration. It's one thing if you want to go back to work because you want to go back to work, but to have to go back to work, that's egregious.
Yeah. Yeah, absolutely. And with your story, I think that is a second opinion was an amazing thing. It saved like all us kids from having our mom get cut up, all these different things. And second opinions, like we said, they save lives, right?
Right, right.
Um, you think you're going on the right track. You told a little story earlier about real estate too. You think you're on the right track. You think you're getting the good advice, but sometimes it's good to check. Things change, right? And
Mm-hmm.
just like you change your doctor as you grow up, you get different doctors for different things that specialize in different things, right?
Mm-hmm.
You're not going to
Right.
go general practitioner if you know, have cancer or you need plastic surgery or whatever it may be,
Right.
right?
Right.
Like you need to go to specialists. And so that's why second opinions really matter, because you can get an idea if you're on track. Are you earning enough income? Are you paying too high fees? That doesn't mean you have to listen to what the person tells you, but it's a really, really good idea
Right.
to check up on yourself, because your retirement portfolio, um, if you make a mistake,
Mm-hmm.
it's really difficult to recover from. Once you're in retirement and you're not earning anymore,
Yep.
at least by going to work,
Yep.
you can really get into some trouble. Now, it's a lot easier to protect your money than it is to try to recover your money, okay? Because math is tricky, right?
Uh-huh.
And if you lose 50%,
Right.
you have to earn 100% to get back to even. That's crazy. Think about that, folks. If you lose 50%, if your assets go down by 50%, you have to earn 100%. How long is it going to take you to earn 100%,
And
right?
that's just to get back to even. That's not making anything. That's just getting back to where you would be if it was in the bank.
That's just to get back to even. So now if you had a couple flat years and then you had a 5% year, a 10% year, but you don't have any down years, you don't lose any money, you're far ahead.
That's
That's
right.
crazy to think about. A 5% year and a 10% year, you're ahead of
Yeah.
the 100%, because the 100% just got you back to even.
Yeah.
And how are you going to earn 100%? Come on.
Right. And that's why you need a second opinion to help you understand, what's going on with your portfolio. King Solomon, the wisest man that ever lived, save Jesus, was, he said that there's wisdom in an abundance of counselors, that you don't wage war without getting counsel. Now, like Daniel said, you don't have to necessarily take the advice of the second opinion, but like the first second opinion we got said, well, whatever your first doctor
Yeah.
said about that
Yeah.
kidney stone, do it. Well,
Right.
that's crazy. I heard what he said. I got the opinion, but I didn't like it. I kept going forward until I
Yeah.
was able to make a decision, and that happened a couple times. But the point being here is that you get this wisdom from other people, and that helps you put things together. I mean, I've got a knee issue that my knees have been giving me issues for various reasons. I've not been kind to my knees. I go to the doctor whenever I have pain. The doctor always either says, I don't know, or surgery. And, my two youngest boys said, Dad, why don't you, massage that muscle in there? And guess what? I massage the muscle and my pain goes away. Thank you, guys. Thank you, Matthew. Thank you, DJ. And they're not even doctors. They're giving me a second opinion, which makes a lot of sense. So I'm listening. I'm listening. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is six things and six things that you need to know to be able to retire in a recession. And we talked about fees, understanding fees, and then we talked about converting money to tax-free nature. We talked about, a lot of different things. We just now talked about how the importance of securing a second opinion is. And we're going to be up for our sixth thing right in a moment. But before we go to that, I want to offer you this paper, Coronavirus and Finances. We don't have time to go through that with how that affects you with your retirement, but we like to put this in your hand. It's 2.5 pages long. You can have it for free, no obligation. 800-725-7616. 800-725-7616. Just ask for it by name, Coronavirus, and we'll send you this paper. Daniel, the next thing, right? We talk about second opinion, but the next thing that's so key when people are the understanding what to do, the 6 keys of retiring in recession is staying up with inflation, right? And being able to have the income they need to replace the paycheck. It's not that you have $1 million, $2 million, $5 million at retirement. That doesn't matter, right? We had a kid ask us the other day, how much do I need to retire? I said, it depends how much what you need to live on. That's what matters. It doesn't matter what your portfolio balance is. It matters what kind of income you can produce from it. And if you're 50 years old or older, you need to start looking at the distribution, the income, and staying up with inflation and ahead of taxation. The thing that I love so much about what's going on with our clients today, Daniel, and if you're a client of ours, please listen at this point, because typically, 1980s, double-digit inflation and double-digit interest rates. Interest rates are 15, 16, 17, 18%, and people who were retiring at that point didn't care that inflation was 10, 11, 12%, because they were making so much more interest. And we haven't seen that, but our clients are seeing that today. It's a beautiful thing. Like Daniel mentioned a few moments ago, the one client that was up multiples, it was well ahead of inflation in regard to her
income increase.
That's what matters. We have clients that are getting double-digit income increases this year for their retirement. I mean, would you like a 10% raise from your employer? Of course you would. Well, that's what we're doing for our retirement, for our clients' portfolios, retirement portfolios. And sometimes it's 10%, sometimes it's 15, sometimes it's 20. I've seen as high as 50% increase with some of our clients. I've seen 5%, I've seen 2%, but most of them are 10%, are double-digit increases this year, staying ahead of inflation. As long as you're ahead of inflation and ahead of taxation, doesn't matter what inflation and taxation is. And that is key that people don't look at. They're given the old storyline, well, the market is the best thing for staying up with inflation. That's another Wall Street myth. Wall Street makes money if the market goes up, if it goes down, if it goes sideways. If your money's invested in the stock market and Wall Street, when do you make money? Only when it goes up. So when it's going down, when it's going sideways, you're not making anything. You're probably even losing money because of fees. Well, that's what we're talking about, is staying ahead of inflation, ahead of taxation, and making money in other ways than stock market. I'm not saying that you can't be invested in stock market, but you have to be invested in the stock market in the right things in the stock market. And then there's other things besides the stock market that will help you stay ahead of inflation and ahead of taxation. And it's the strategy that's the most important part. More than investment vehicles, it's the strategy. That's why this show is called Financial Strategies, because it's the strategies that make a difference. Strategies versus planning. Planning's change, strategies don't. There's strategies that work, and you just work the strategy to win the war, to win the game, right? And that's what we're talking about, being able to stay ahead. You need to understand how to stay ahead of taxation. This aspect of and I'm sorry, Daniel, I'm talking, but the strategy of tax, becoming tax-free is a great way to compound and stay ahead of taxation and inflation as well.
But all of these, it's so great. All of these, you can see those second and third order consequences. The Roth, like you said, you do the conversion, you take that hit, and then it carries on. That helps you with inflation, because now when you earn $60,000, $100,000 in dividends, you get to spend $100,000. Now, you probably want to keep reinvesting so it keeps compounding. But the point is, you can take that 25 of it is not disappearing to taxes, right? And you're only getting 75. Now you can take 75 and reinvest the other 25 and keep compounding. So next year you get more than 75, right? And then it's the same thing with rolling it over because people talk about stocks being a good inflation hedge. And the part that they miss is when you look at the 70s, the ones that were good inflation hedges were the dividend stocks, the ones that were increasing. You look for individual companies that have free, outstanding free cash flows, right? They just have money pouring into them. So you can get it multiple ways, right? What we call upgrades, where we see one company that's valued at this and one company that's valued at this. And we say it doesn't make sense for this company to be valued so low. And you swap out and increase the income. The other is the company just increases the dividend. They just increase the income that they're paying to you, right? And that's all to help you keep up compounding and keep up with inflation, right? As you
Yeah.
mentioned earlier, the eighth wonder of the world is that compounding.
And then there's that beautiful thing, not other than the stock market, whatnot, that one account, right? That so many people like that goes up when the market goes up, but doesn't come down when the market comes down. That's a beautiful thing to have people be able to still take advantage of when the stock market goes up if you're enamored with the stock market, but still not lose principal. Beautiful thing. Well, you've been listening to Financial Strategies with Andrew and Daniel Agemy, and we've had a great time today and trust that you've been educated and uplifted and value added to your life to be able to make good decisions on purpose because you're educated in a way you haven't been before. For more education, call us at 800-725-7616. Part of that education we're offering you today is a free $2,000 report, retirement risk report, that will give you a second opinion. It will help you look at to know what your fees are, to understand how it will react if the market goes down further or goes down again at another point in time, and helps you understand what you're on track for currently in regard to retirement and what you can do if you're not on track for retirement. Call us 800-725-7616 because you're a listener to this podcast and to our radio show. You get it for free. 800-725-7616. Call now. Ask for it by name, Retirement Risk Report. And we want you to we believe that an educated retiree is a happy and stress-free retiree.